The spectacular collapse of the global NFT market followed the exact ruthless trajectory of a classic financial bubble. Before the frenzy, non-fungible tokens were a niche application of blockchain technology. They were designed as a specialized tool to establish verifiable digital scarcity on distributed ledgers. The shift toward a speculative mania began with a global macroeconomic shock. As the pandemic paralyzed the economy in early 2020, central banks worldwide responded with an intervention of massive scale. Interest rates were slashed to historic, near-zero lows, while governments injected trillions of dollars directly into the economy through stimulus checks. This flood of easy money severely depressed the yields on safe haven assets, such as government bonds. This sudden abundance of capital pushed both retail and institutional investors further out on the risk curve. Society was now primed for a speculative explosion. The market entered a state of absolute euphoria in March 2021. The artist, known as Veblen, sold a digital collage at Christie's for $69.3 million, signaling to global speculators that digital hashes could command valuations rivaling the masterworks of fine art. High-profile NFTs began to function as Veblen goods. In most markets, demand drops as prices rise, but for Veblen goods, the exorbitant price tag is the primary feature. These tokens became dematerialized status symbols, allowing owners to signal their wealth and technological savvy on a global scale. This search for status collided with the greater fool theory. Investors ignored intrinsic value entirely, purchasing overvalued assets with the expectation that a successive buyer would materialize tomorrow, willing to pay even more. Corporate marketing machines accelerated this cycle by enlisting A-list celebrities and television hosts. They showcased their Bored Ape acquisitions to millions of viewers, intentionally manufacturing a wave of mainstream fear of missing out. The combination of Veblen signaling and celebrity-driven FOMO completely overrode rational risk management. It created a massive architecture of paper wealth built on a foundation of collective psychological delusion. To sustain this decentralized Ponzi structure, the market required the persistent illusion of massive trading volume and stable valuations. That illusion was manufactured through wash trading. This occurs when an entity trades a single asset back and forth between its own wallets to artificially inflate historical volume and price without any real capital entering the ecosystem. The scale of this manipulation was enormous. In 2022, wash trading generated an estimated $21 billion in purely artificial volume, accounting for up to 80% of the activity on some major platforms. Retail investors, misled by these engineered metrics, provided the real capital that allowed institutional insiders and early adopters to cash out. The cycle turned violently in 2022. As global inflation surged, central banks initiated aggressive quantitative tightening and rapid interest rate hikes. The opportunity cost of capital rose sharply, instantly vaporizing the easy money that had fueled the speculative boom. The result was a systemic liquidity crunch. As major crypto exchanges collapsed, NFT trading volumes plummeted 92%. The market froze. Buyers were left holding highly illiquid tokens. By year's end, over 95% of all NFT collections were functionally worthless. This was the panic phase of the market cycle. Without fundamental anchors like dividends or earnings, the market was purged of its unsustainable valuations. The crash decimated high-profile portfolios. Justin Bieber purchased a Bored Ape at the zenith of the mania for $1.3 million. By 2026, its value had dropped to roughly $12,000, a 99% wipeout of principal. A legal reckoning followed. Federal regulators fined celebrity promoters for unlawful touting and targeted NFT creators who structured their project sales as unregistered securities. The crash also exposed a technological fallacy. In a metadata rug pull, developers for the Raccoon Secret Society arbitrarily replaced their investors' digital art with images of dead bones. It revealed that buyers often did not own cryptographically immutable art. Instead, they owned fragile hyperlinks pointing to centralized servers that could be altered or deleted at any moment. This evolutionary filter was necessary to burn away the grift and the false promises of the bubble era. The cultural reputation of the ecosystem was severely damaged by its environmental footprint. Prior to 2022, the network's energy requirements created a carbon footprint per transaction equivalent to driving a gasoline vehicle for hundreds of miles. Ultimately, human attention shifted. As the NFT market collapsed, capital and interest migrated toward the tangible utility of generative artificial intelligence, offering immediate economic productivity. The cultural zeitgeist abandoned the speculative complexities of the metaverse for technologies that provided clear, functional value through a standard web browser. Despite the evaporation of the retail mania, the foundational mathematics of smart contracts survived. The surviving blockchain infrastructure is now transitioning into a silent background system. It is being integrated into logistics, secure digital identity, and enterprise backend systems, where the focus is utility rather than speculation. The noisy, celebrity-driven chaos of 2021 has been replaced by a quiet, functional adaptation. The crash was not a tragedy, but a macroeconomic clearing, a purge of human irrationality to make room for a lasting digital infrastructure. To understand the hidden structural forces shaping the future of wealth, subscribe and stay ahead of the next market shift.